Welcome, everyone, to this definitive masterclass explainer. Today, we're going to walk step by step through the intricacies of international expansion for the ICEW BPT 2025 exam. Now, as students of this material, you know, the international dimension of corporation tax, it can carry a pretty heavy cognitive load. But hey, don't worry. We're taking it nice and slow today, a very deliberate pace. We'll break these complex rules down into clear, logical frameworks that you can apply directly to your exam scenarios. So, grab your notes, get focused, and let's master this together. Okay, let's dive into this. Here's our 6-part roadmap for today's lecture. We're starting with the bedrock, corporate residence. Then, we'll define permanent establishments, compare branches with subsidiaries, and tackle the actual mechanics of migration and incorporation. After that, we conquer the math behind double tax relief and wrap it all up with some essential exam strategy. Having this structure, it just makes the whole journey much more manageable. Right. Section 1. Corporate residence and tax scope. Remember, before a single tax calculation can even begin, we absolutely must establish our legal foundation. Residence is the starting point for every international tax question.
So there are 2 tests for UK residence. The first one is super simple. Incorporation. If a company is registered at Companies House, boom, it's UK resident. Full stop. The second test, and this is where I need you to pay close attention, is Central Management and Control, or CM&C. This refers to the highest level of strategic decision-making. Now, HMRC is looking at the actual substance here. Where are the real decisions being made? They aren't fooled by a formal board meeting in the Bahamas if the real executives are pulling the strings from an office in London. Actually, scratch that. It's not about where the paper is signed at all. It's about substance over form. That is the golden rule here.
And this brilliantly illustrates how residence dictates the scope of UK corporation tax. A UK resident company? It's caught on its worldwide income and gains, though yes, subject to double tax relief. But a non-resident company has a much narrower scope. The source principle applies strictly to UK PE profits and land. Now, look closely at the bottom 3 rows. You absolutely must memorize these key dates. Non-residents are taxed on UK residential property gains from the 6th of April 2015 and non-residential property from the 6th of April 2019. Oh, and note that critical 75% threshold. If an offshore holding company has shares where at least 75% of the gross asset value derives from UK land, those are considered property-rich assets, meaning they are firmly caught in the UK tax net.
Moving right along to Section 2, defining permanent establishments. If residence is the foundation, while the permanent establishment, the PE, is the absolute linchpin of international tax.
I want you to read this definition deliberately alongside me. A PE is a fixed place of business through which the core business of the enterprise is carried on. Let's break down those 3 vital elements. It's got to be a place, right? Like physical premises or actual equipment. It must be fixed, meaning there's a degree of permanence, not just, a passing visit. And finally, the core business must be carried on right there. Also, keep in mind, a dependent agent who habitually concludes contracts on your behalf, that will create a PE. Contrast that with an independent agent like a general broker, who doesn't tie you down in the same way.
But what is not a PE? Things like storage, purchasing goods, or gathering information. Why? Well, because these are merely preparatory or auxiliary activities. They're the support act, not the main event. Now, let's look at digital infrastructure, because this trips people up. Under OECD consensus, a website itself is never a PE because it totally lacks a physical presence. However, a physical server located in a specific country, that could be a PE, but only if it actively processes orders and conducts core business functions, rather than just passively hosting a web page.
Okay, Section 3, branch versus overseas subsidiary. We're moving from legal definitions into strategic application now. This is one of the most common and critical scenarios you're going to face as an advisor.
Let's walk through this direct comparison methodically. Structurally, a branch is literally just a physical extension of the UK company. A subsidiary, on the other hand, is a completely separate legal entity. Now, the strategic timeline is everything here. In the early, loss-making years of a new overseas venture, you absolutely want a branch. Why? Because those early branch losses can be set against your UK profits immediately, saving you cash flow. Plus, you get UK capital allowances on the assets, and there's no transfer pricing on yourself. But later, when the operation takes off and becomes highly profitable, you transition into a subsidiary. Why? Because its profits and the dividends it pays back to the UK are generally exempt from UK corporation tax. Just remember, the moment you move to a subsidiary, strict transfer pricing rules kick in. So the crucial point here is the PE exemption election. This is kind of a middle way, but, well, it comes with extreme danger. You can elect to exempt all your overseas branch profits from UK tax. But listen to this very carefully. It is an irreversible choice. Once you make this election, you permanently forfeit all future loss relief across every single overseas branch you have. It's an irreversible trade-off. Seriously, do not recommend this if there is even a slight chance the overseas operations will generate losses in the future.
Let's turn to Section 4, Migration and PE Incorporation. Have your pens ready, please, as we explore the mechanics of structurally moving companies and branches across borders. Trace this timeline of exit charges with me nice and slowly. When a company migrates its residents out of the UK, it triggers exit charges. That basically means all its assets are deemed to be sold at market value right then and there. Now, for historic migrations, before January 1, 2020, there was a bit of a safety net. A 75% subsidiary could elect to defer these charges, which would then crystallize if an asset was sold within a 6-year window. But, note the final point. For any modern migration post-January 1, 2020, that deferral has been completely abolished. Gone. Immediate exit charges apply today.
Now, you absolutely must distinguish clearly between an entire company migrating and merely incorporating a branch into a subsidiary. When the whole company migrates, meaning its central management and control literally moves overseas, you trigger those immediate exit charges we just talked about. But when you're just incorporating a PE, you're transferring the trade and assets to a new overseas subsidiary in exchange for shares. Gains still arise on the transferred assets, but they can be deferred. Crucially, and you'll want to highlight this November 22, 2017 rule, if the shares in that new subsidiary are later sold via a share-for-share exchange, those deferred gains are protected from crystallization. It's a huge distinction.
All right, take a deep breath. Section 5, Double Tax Relief Rules. Welcome to the most mathematically rigorous part of our masterclass. I'm going to need your absolute, undivided focus for this next segment. Here is an unbreakable law of tax. Double tax relief will always be limited to the lower of two things: the overseas tax suffered on a specific source, or the UK corporation tax attributed to that exact same source. The fundamental principle here: the UK will never give away more credit than the tax it is actually charging on that specific piece of overseas income. No way.
Let's move to and see how this builds into an exact exam algorithm. Step 1. Always bring the overseas income in gross before tax. Step 2. Set your UK losses against UK income first and then against your lowest rate overseas income. Step 3. Calculate your total UK corporation tax on the remaining profits. Okay then. You save your highest rate overseas income for Step 4, where you calculate DTR source by source, starting with the highest overseas rate. This mathematical logic is absolutely crucial because it ensures you maximize your DTR claim by using up your UK tax capacity against the most expensively taxed foreign income first. Finally, Step 5 is simply deducting that total DTR from your UK corporation tax liability. It's a puzzle, but a logical one.
But what happens if you have massive UK losses, completely wiping out your UK tax liability to zero? Well, in that scenario, standard DTR is basically worthless. You can't credit overseas tax against zero UK tax, right? And this is exactly why expense relief exists. If you elect for expense relief, you bring the overseas income into your computation net of the overseas tax. This effectively means you use less of your UK losses to cover the foreign income, preserving those precious losses so you can carry them forward to future years. It's an absolute lifeline for struggling companies.
Now, when overseas tax exceeds the UK tax, that excess is called unrelieved foreign tax, or UFT. You need to memorize the contrasting harshness of these rules, so read them deliberately with me. For an overseas branch, UFT can be carried back 3 years on a LIFO basis, last in, first out, and then forward indefinitely, but only against profits from that exact same branch. However, for overseas interest and overseas property income, that UFT is completely and permanently lost. It's gone. It cannot go anywhere.
Finally, Section 6, Essential BPT Exam Strategy. Let's put on our exam coach hats for this final stretch and synthesize all this heavy theory into actual passing marks.
All right, rapid fire. Here's your systematic, structured approach for exam day. Always frame the question by establishing residence first. That dictates your entire analytical framework. When you're evaluating structures, contrast the branch early loss phase with the subsidiary later profit phase. If you're discussing the PE exemption, explicitly state that it is irrevocable and kills loss relief. When calculating DTR, follow that 5-step sequence mechanically. Look out for 100% loss scenarios so you can recommend expense relief. And finally, watch out for trapped interest and property UFT in those tricky multi-source questions.
Now, what's really interesting about this slide is the ultimate challenge it presents, based on everything we've just covered. If a client expects 5 years of overseas losses, followed by massive profits, what is the exact timeline of structural changes you'd advise? Think about it. You start them as a branch to soak up those early losses against UK tax. Then, right as they turn the corner into profitability, boom, you execute an incorporation into an overseas subsidiary to shelter those profits. Apply this logic, remember the frameworks, and you will absolutely excel. Keep reviewing these notes, and thank you so much for joining this Masterclass Explainer.